Okay, um, how's it going, everybody? So I figured I'd make a quick video today, just going over really like the latest employment numbers for really the states and metros that were released for the month of July, this past Friday, the 16th of August. And just kind of give you my thoughts on that, but kind of really before uh, getting into that, I just kind of wanted to explain. Uh, Really, we're going to be looking at employment more than anything, rather than the unemployment rate when it comes to states and metros, and this I think is pretty obvious for a lot of people who pay attention to macro and whatnot, but I think that people are really intimidated by uh, employment metrics, a variety of different macro uh, data points out there, when in reality it's not rocket science. I mean, ultimately, people just need access to the data. They need to understand some basic trends and how certain things are related. And once you understand those basic things, it's much easier to interpret maybe what appears at first glance as sort of a busy visual. And uh, I'm here to tell you that it's really not that uh, difficult of a concept to understand, at least employment, in my opinion. So, real quick, I'm just going to just basically explain the fact that when you don't have employment growth, you're eventually going to see the unemployment rate spike. And we're looking at national employment numbers. Uh, and yes, there's a lot of nuance when it comes to the unemployment rate in terms of the labor force flows and things like that. But in the simplest way to think about, uh, employment on one side versus the unemployment rate really on the other side, is that again, when employment, when jobs growth slows, the unemployment rate is going to move higher. So this top left chart is simply a line chart of non-farm payrolls. So it's showing roughly 159 million jobs as of July. And this chart, as you can see, goes all the way back to the 1950s to those most recent numbers. But that line on its own doesn't really tell me much information. Uh, so that's the point of showing this chart over here to the right, where essentially what I'm doing, and notice that it's the same number, it's 159 million, give or take. But this time I've set it up to where I'm showing the stock of jobs and how much each sector sort of comprises in terms of total non-farm payrolls. Again, this is the non-farm payrolls is the headline number you see on a monthly basis. When people talk about the jobs report, they talk primarily about the non-farm payrolls number, and that comes from the establishment survey. So this without getting too into the weeds, the establishment survey doesn't make any distinction for multiple job holders. So, you know, theoretically, one person can be on multiple payrolls and it all gets counted, versus the household survey, which is where the unemployment rate comes from. That is, one person, one job. And the coverage between those two is different. The establishment survey, really, the non farm payrolls number that you're looking at, that is employer facing, sort of as the name suggests. The household survey is going to be more consumer facing. So uh, it's important to really look at both of them, but it's also just important to understand really what I would consider the most important concept, and that is when you don't have job growth, it's ultimately going to lead to a spike in the unemployment rate. So, you know, I I really do think that anybody can understand this information, and I would prefer to just eliminate all the noise, all the mainstream media narrative spin, which is so terrible now. And it's really unfortunate because it really just it serves to confuse people. And there's so many conflicts of interest out there and competing narratives that are all being monetized in some way, shape, or form. So let's just cut through the noise. Let's look at this information over a long period of time and just make some basic observations. And then obviously, we're looking at the national numbers, but we're going to move to state specific employment trends as well as metro specific employment trends. So just kind of moving down here, I mean, like I was suggesting, job growth is going to slow, then you're going to see the unemployment rate spike. It's pretty obvious. Uh, you know, Over here in this bottom right chart, it's the same thing. I just have the unemployment rate inverted. I just flipped it upside down so you can see the relationship a little bit better. But yeah, I mean, this is the same thing you see throughout history. If you want to think about it in terms of a level, I mean, obviously when it's flattening out, you're seeing job growth slowing, then it's an outright contraction. That was obviously the recession of the 80s. Then you have job growth picking up, as we see, and then of course it contracts here in the 90s, and then it's that same cycle over and over and over again. So, not rocket science here, folks. But now, so let's look at employment by industry for a state like Arizona. And again, the remainder of these visuals are not nowhere on there are you going to find the unemployment rate. I've said this until I'm blue in the face. The BLS has like a flow chart on their website that walks you through how labor force flows can be influenced. And unless you sort of understand that pretty well, you're not really going to fully understand why or how the unemployment rate, especially late cycle, when you get way into um, late cycle in terms of interest rates, uh, you're going to see the unemployment rate move higher and steepen. So it's going to move higher non-linearly. So that being said, again, this is we're looking at non-farm payrolls here. So these are the establishment survey numbers we're going to look at for the remainder of both for the states and for the metros. And the reason I am a broken record about labor and jobs and everything is because at the end of the day, it's all connected to GDP and really the housing market. You want to focus on really two things right now, it would be labor and the housing market. So people don't experience uh, these labor trends that you see at a national level. Ultimately, they want to understand what it looks like for their market. Is there a reason you're not getting a call back for that job application that you submitted, or same thing for an interview, whatever it may be? I mean, the reality is the jobs market is quite weak, and I've heard a lot of folks say, "Well, it's all this information it gets revised all the time. It's statistically insignificant. There's so much noise in this. It's not really you just need to ignore that." No, that's just fundamentally that person is just lying to you. Uh, yes, these are monthly estimates that are subject to revision just like anything really in the in the macro space. But you know, even if you were to pull sort of the source data for something like this, which is the quarterly census of employment and wages, the trend is going to be identical, pretty much. I mean, the level is not going to be the same, and in fact, we know that a lot of the gains that we've seen in employment for the establishment survey are in fact overstated. So just think about that when you also look at this information. So that being said, I'm going to walk through how why I have this information configured the way that I do. It's the same information presented three different ways, and this allows me to efficiently process a lot of information all at once. So the top left chart is the stock of jobs. That's non-farm payrolls. That's going to be in thousands. So you're looking at roughly what 3+ million jobs in the state of Arizona. Below that, and of course that goes back to the 90s and it's through current day of July 2024. Below that is the year-over-year percentage change by industry, and that's of course zoomed in very like way more near term. So it dates back to 2021, and it's through July 2024 because we want to be able to identify longer term trends, but also see in very specific detail what industries are slowing the most. And the reason you got to present it this way is because we're putting everything on the same like level playing field. I look at this bottom left chart, I see information is negative year over year. It looks to be the weakest. But as a share of the stock of jobs, it's quite small. As you can see, I mean, you can barely even see the yellow up above that in the stock of jobs. Uh, and then to the right of that, which has the legend for all three, that is, it's essentially, I mean, it's a stacked bar chart, just like the top left chart is for a purpose. So you're seeing the year over year change in actual payroll or head counts. So that's why it's you're I'm showing it that way. So this is what I would consider to be adequate context. Now I'm going to just walk through my interpretation of what I'm seeing near term and why I think the jobs market is weak. And this is the same thing you're going to see pretty much throughout. Uh, various states and metro areas. Near term, private education and health services, as well as government jobs, are accounting for the bulk of the job growth year over year. Historically, that is a very unhealthy pattern because you see that in recessionary periods. Look back to .com, look back to GFC. You're seeing a lot of pink and blue accounting for really a lot of job growth. So you need broad-based participation across all of these sectors, and we're not seeing that. Uh, it's not as if these different sectors are siloed per se. That's just not how the economy works. So that would just be a very naive way of thinking about it. Uh, so yeah, this is an unhealthy trend, and honestly, it's going to continue to get worse. You're going to continue to see softening job growth across states and metros. The rate of change will be different. Not every market's the same, uh, but that's what you're going to see. So, and by the way, private education and health services, those are, if I haven't already said it, those are primarily healthcare jobs. So let me jump over here to California and let's just see what that looks like. Obviously, there's more people in California, and so that's the advantage of having these zoom slicers on here, because I can zoom in, zoom out, because obviously, here, I'll just use an example. COVID really distorts this information. It's hard to really see. I mean, you can see it zoomed way out, but it's much easier to see if you kind of zoom way in on it. And you're still gaining context from that. You're not really like, you know, cherry picking anything here. We're just trying to see what's happening near term. And what do you know? It's the same thing. It's that same pattern. So I'm going to click through some other ones here real quickly. Here's Ohio. Again, that wonky COVID sort of distortion. And we're seeing that same similar move. I mean, golly, Ohio got wrecked really between 2000 to 2010, 2011. Detroit looks a lot like this as well. So this makes me want to take a deeper look at some of these Ohio markets. Uh, yeah, not a pretty pattern. This is when I look at something like this. Also, it's like, well, is this coming from Columbus or Cincinnati or Cleveland? Where is the weakness? And likely you're going to see it to varying degrees, the same pattern, even in a lot of those metros. So Tennessee, I mean, that is a pretty ugly trend. I look, I've looked at a lot of these metros, and I can tell you essentially Memphis looks the worst, but we'll take just a glance at that here later on. So again, you need job growth, especially if your population is growing, for the unemployment rate to remain low. Uh, and we're just seeing job growth roll over in the state of Tennessee. But we'll dig into that a little bit more. But look, we're looking at states in isolation. What if we just compare segments of employment across different states? And what you're going to notice here, and by the way, these are the same charts. One is zoomed way out all the way to the into the 90s to current day, whereas again, this is a shorter look back. So we're trying to figure out which market or which state has the weakest private employment growth. And again, total private, when people talk about that, I know I'm sort of like oversimplifying things here, but just to make it simple, stupid, that's just all that's non-farm payrolls, ex government jobs. So, uh, Tennessee doesn't have really any private sector job growth. And it's that same pattern you're seeing over time. In fact, right now for the state of Tennessee, it actually looks weaker. Private job growth looks weaker than it did. You know, it's you're kind of like right there at the '07, '08 sort of time period, or even if you want to look at GFC, you're right at end of 2000, 2001. But yeah, I mean, that's just another way of making sense of this information, because I don't want anybody to accuse me of not looking at this at scale. I mean, all when I pull this information from these government databases, I'm not just pulling one, I pull the entire thing. So I don't want to just be seeing what I want to see. I want to make sure that these are patterns that can be observed at scale. And the reality is they are, because you're starting to see these patterns get picked up even in something like the unemployment rate. So now, rather than looking at just jobs, why don't we take sort of a different approach to see where maybe the labor market is going? And we can look at something like average weekly earnings. And this is for private employees. And what you notice, I'll highlight Tennessee as an example. This data set only goes back to like 2007. But what you generally notice in a downturn is that, earnings either uh, earnings growth slows or outright contracts. And so you see a bit of a topping pattern. That's pretty consistent with the last real downturn that we had, like a real recession, which, in my opinion, that's GFC. So that's because, when an employee has more negotiating power because their services are in demand, uh, their wage is going to reflect that. The opposite of that scenario is playing out right now. So uh, now, what if we look at, say, what average weekly earnings looks like across different industries and by state? So this is Tennessee, and really, it's that same sort of pattern that I was alluding to, and it affects different sectors differently. But the point I want to make, and this is really important in understanding and just looking at jobs numbers just exclusively on their own for any market, is that I want to focus on where there could be pressure points for something like housing potentially. So if you see contraction in a large segment of jobs, and those jobs happen to be, generally speaking, higher paying, that does not necessarily bode well for housing prices being sticky in a particular market. And we're looking at it for the state of Tennessee, but you can do pretty much kind of the same thing at a metro level. So, uh, financial activities, that's going to be your bankers, real estate agents. Information, that's like a lot of broadcasting folks, even software publishing, professional business services. That's going to be like a lot of office type workers. And it's not just limited to, say, like architects or engineers or people like that. That captures administrative folks too. So I kind of think of that as, broadly speaking, white collar. But yes, this is something that we got to pay attention to. Uh, you know, this is kind of a noisy data set, but professional business services has seen an absolutely enormous amount of growth over the past 15 years. And a lot of these markets, it's either the largest employment sector or it's close to it. So that's one that is definitely worth keeping an eye on. So now we're going to transition over to metro level employment. And it's the same setup that I showed previously for the states. So we're just looking at the same thing, but now at a metro level. So Atlanta, when I'm, maybe comparing it against some of the other states I've looked at, yes, a lot of, we'll call it healthcare and government jobs near term, accounting for a decent amount of growth. But I'm seeing a decent amount of participation, across some of these other sectors. Leisure and hospitality is doing okay. I mean, it's slowing near term. It's seen a bit of a rebound in the past, we'll call it, couple of months. Financial activities, implications obviously there for housing, seems relatively strong. I mean, it is contracting a little bit. It's hard to know, how much of that is base effects. But again, we're seeing information, professional and business services rolling over year. I just add one more thing about the Atlanta market is, and this is really true for like a lot of the Sunbelt markets, is there's been so much investor activity in a market like Atlanta in terms of just, oh my gosh, there have been so many people just buying up houses down there who have no, I mean, it's your landlord bros. Uh, it could be short-term rentals, all sorts of things. So Austin, I know a lot of people love to talk about Austin in terms of really the housing market. So you're seeing job growth slow here too. There's a lot of professional and business services jobs in this market. That green area, light green, obviously that's negative year over year. The story really in Austin in terms of the housing market is a few things. The demographics don't support it, and basically what I mean is that it's a relatively younger city, especially like city center in Travis County. There's a way too much like new home supply, and particularly on the multifamily side. And now, I mean, just net migration. It's no longer really supportive in terms of where there could be, where the housing stock has the ability to absorb both existing and new supply. So I could go on about that. I won't, but really, that's not a story that's exclusive to Austin either, and it's going to come to some of these other markets. Uh, but that's just my opinion. So now, why don't we just look at uh, Tennessee, because that one looked pretty ugly at the state level, and we'll start with Chattanooga. And here's what I'd say about Chattanooga. Talk about a wonky looking near term move. A lot of healthcare jobs here, right? This is a, financial activities remains pretty strong. The housing market actually looks pretty decent in Chattanooga. What this is, here's what I would say. It depends on what part of the MSA that you're looking at, but this is generally speaking an older population. So, people here, you know, something like the employment population ratio is going to be a lot lower because generally speaking, there's older people here. Uh, they have they've had a longer time to accumulate assets. You've had people come to this market, pay cash for homes. Uh, that is also something that you see in kind of like a place like Asheville and even some of these, a lot of really kind of northeastern markets. But when I look at that near term trend, it still doesn't make a whole heck of a lot of sense because there's not broad based participation. It's slowing, but the rate of change is not evenly sort of distributed. So that's something to kind of keep an eye on. Let me now I'll jump down to uh, Memphis. And for those of you who aren't familiar with Memphis, it's just a train wreck. It's always been a train wreck, and it is especially a train wreck now. I mean, look, you haven't really seen a lot of job growth over the years, and part of that is due to just the population in a place like Memphis not growing really considerably, and so the labor force kind of reflects that, and you can, as a result, you can have a scenario where the unemployment rate can tick down under those circumstances. But I don't want to confuse anybody. Uh, but I did want to at least bring that to people's attention. So really, healthcare is the only thing, maybe a little bit of uh, other services and construction that's accounting for year-over-year job growth in a place like Memphis. Really unhealthy uh, move. Okay, so I'll move to my hometown of Nashville, and what I'm noticing is a very similar trend of really only the only job growth we have is in healthcare and pretty much government. But notice financial activities, professional business services, even leisure and hospitality, and obviously construction and information are negative year over year. People cannot get it through their head that the Nashville labor market, the economy, and by extension, our housing market, it's going to be more sensitive to these cycles. We are a more cyclical economy now. There's way too many, sort of consultants. That is what I, you know, sort of jokingly refer to as a lot of these professional business services folks. There's just way too much of that in town. You see that not only in Nashville, we saw that in Austin. You see it in a lot of these Sunbelt markets. So it's starting to contract. We know that these are higher earners. And here's what I'll say too is I have people push back and they say, well, hey, like, is this, what if, what about the work from home people? And I would just say, uh, most people work where they live. They may not necessarily work in the county in which they live, but most people, generally speaking, work in and around where they live. So these numbers reflect jobs where the employer is located. Again, the establishment survey, it's employer facing. The household survey, when you look at this at a local level, it's not that the household survey doesn't just capture the unemployment rate at a local level. You can also look at just the outright estimate of jobs from that survey at the MSA. And when you do that, it basically it shows this same pattern. So, uh, you know, I have pretty much heard every sort of excuse as to, well, you're not looking at that right, or what have you thought about this or thought about that? I mean, the reality is a lot of those things that people love to bring up to try and poke holes in arguments, there's a decent chance that there is a survey out there, uh, you know, produced by where's the census or some government agency that's going to capture stuff like that. Just go look at the American Community Survey if you don't believe me. So, okay, I'll point out just one more metro in the state of Tennessee because we wanted to focus, in on Tennessee because of the pattern that we saw. And Knoxville. I mean, a lot of trade, transportation, utility jobs here, and decent amount of manufacturing. That is again not a great near-term pattern. I was actually pretty bullish on Knoxville. I think their home prices will actually hang in there a bit better than Nashville. They'll still contract, but there's less signs of overbuilding in this market. The people who have moved here are a little older, and by extension, they're going to be a little bit more like financially stable, but it's going to depend where you look within the MSA. But that near term pattern is starting to look a whole heck of a lot like Chattanooga. So it's just something we got to keep an eye on. But now we'll just do really quickly the same thing where we're just kind of comparing jobs across different metros to see what those patterns look like. And as we can see, I've got a lot of Tennessee metros on here, compared against Detroit, Cape Coral, Fort Myers, a variety of metros, even New York. I mean, that's obviously a big one, right? So that pretty much shows me that Johnson City, Nashville, they're all underperforming a place like New York City. And this shows that really, I mean, look, just kind of compare the two here. Base effects aside, this indicates to me that Nashville is just it's it's weaker than it has been in terms of job growth compared to previous cycles if you're just looking at total private benchmarked against the biggest metro in the country, that is New York. So all right, we'll look at one more. This gets back to that other approach to making sense of jobs, and let's just approach it from average weekly earnings. And this is again total private. It's that same topping pattern, right? I mean, you're seeing it. It's that same top. That's not healthy. It's cookie cutter clear as to what that trend looked like in 2010. We got Vegas here too. That's topping out. Even that's happening in Miami. So all of these things are just. I mean, look, we're doing is looking at the data. I know all of these talking heads like Jim Cramer and Dave Ramsey with their spin and all this. What we did is we just went through just a handful of states and metros to make sense of what's happening. We did that to look at things at scale. These are the numbers straight from the BLS. All I did was pull the whole thing out and just create some visualizations to try and really understand the trend. So those guys on TV, those asshats, they'll show you like a 2 or 3 month chart and try and say, oh, it's a new trend or it's a new bull market. I mean, we're looking at things over a long period of time, and this is giving you way more context, and this is telling you quite clearly that the labor market is slowing, and by extension, the economy is slowing, not only at a national level, but at a very local level. There's a reason you're not getting a call back about that application or, that second interview. I mean, job growth is just slowing here locally. You know, if you don't believe any of this information, just look. I'm a big believer in people just being empowered to look into things themselves, and it's really not that difficult. Just Google something like employees in Nashville, followed by, the word Fred as like a name, FRED. And that's going to probably pull up the employment numbers for whatever metro or whatever state that you're looking at or that you're interested in. So uh, I've just presented it in a way where it's much more efficient for me to process a lot of information at one time. And so that's why I've shown it this way. So, I, you know, I, anybody who is not willing to show you a chart, just do not listen to them. They're just a bunch of asshats. Dave Ramsey just loves to talk at people. He loves to belittle people. He's been emboldened by his own stupidity because unfortunately the government had his back, especially for the past 15 years, and that's really unfortunate. But that's what's happened. So, uh, yeah, I mean, guys, that's pretty much all I have. But uh, if there's a particular market that you'd like me to look at, maybe more in depth, and we can even pair this and look at some charts around real estate activity and even demographics at a very granular level. I have all that information too, trended over time, and I, I look at that stuff at scale too, just like I look at the employment numbers too. In fact, I'm not interested in looking at it any other way because I don't want to extrapolate something I'm seeing at my local, in my local market and assume that that same sort of trend is happening elsewhere. So again, with the context, uh, but yeah, we can do that, and we can maybe even hone in on a, or a particular market. Or maybe we just want to talk about demographics. We can do that as well. So anyway, I'll quit rambling. Hopefully that was halfway helpful. And if you like this content, be sure to click that like, subscribe button, and yeah, I'd be happy to put out more of this. Okay, guys, that's all I got.